All right, hello and welcome everybody to today's webinar. This webinar is brought to you by OctaFX, leading Forex broker and winner of multiple awards in the industry. Today we're going to be talking about Elliott Wave Theory, a really important field within technical analysis. So I'm really excited to share some ideas with you today, which I think you're going to find useful in your trading and in developing trading strategies. So without further ado, let's jump right in. First of all, a couple of quick disclaimers. Trading on margin carries a high level of risk and may not be suitable for all investors. You should not invest money that you cannot afford to lose. Secondly, a hypothetical trading disclaimer: the information in this webinar is provided as general market commentary and does not constitute investment advice. So in other words, we're not giving out specific trade recommendations. Let's talk about what we're going to cover today. Today we're going to cover the fundamentals of Elliott Wave Theory. This is a very complex theory in a large field. You have people that spend their entire lives studying Elliott Wave Theory. So obviously we're just going to scratch the surface today in this webinar. It's only about half an hour, but you will be able to take away several key concepts within the theory, which I think you will be able to find useful in your trading and be able to apply to your trading right away and kind of form a bridge into getting into Elliott Wave Theory for a deeper study. So as a starting point, we'll explain the basic 5-wave impulse sequence followed by the 3-wave corrective sequence. This creates a complete Elliott wave sequence with a total of 8 waves. So this is really the underlying concept of the whole theory. It's very important stuff. We'll cover the fractal nature of Elliott waves and also some unbreakable rules for correctly identifying the Elliott wave sequence. Let's talk about the man himself that came up with this theory, Ralph Nelson Elliott, briefly. Ralph Nelson Elliott, originally from Kansas, not a typical sort of New York Wall Street guy as you might expect, and he was an accountant by trade before becoming a stock market analyst late in life. His extensive research led him to develop the wave principle, a theory that prices unfold in specific patterns called Elliott waves. More recently, in the later part of the 20th century, his ideas were popularized by a guy called Robert Prechter. Prechter was with Merrill Lynch, where he'd been a market technician, and in the late 70s published his first issue of the Elliott Wave Theorist. Incidentally, Robert Prechter was a student of psychology at Yale University, which I think is no coincidence because, as we'll see, Elliott Wave Theory is based on the psychology of crowds. So let's talk about the wave principle. Elliott's research led him to believe that while market movements appear random, they actually follow predictable natural laws. Back in the early 30s, Elliott studied 75 years of historical market data, and you can imagine that without the technology that we have today, this was a fairly massive undertaking. He wasn't able just to pull up weekly and yearly charts on his MetaTrader and do that kind of analysis. It all had to be done by hand. So he arrived, after studying this massive amount of market information, he arrived at the conclusion that markets don't move in a random manner, and that prices move in these repetitive cycles which reflect the emotions of investors, the psychology of investors. So later on that decade, at the age of 66, he shared the results of his studies in a book called The Wave Principle. Mr. Elliott did his analysis on the stock market, but the theory can be applied and is used by professionals and retail traders across multiple markets, including commodities, Forex, and there's probably people applying it to even cryptocurrencies now. So this is something that applies across all markets. So again, his theory holds that collective psychology drives the movement of the markets, and that if you can correctly identify these repetitive wave patterns, you can predict where price will move next. So in identifying these wave patterns, this gives you this has predictive value and helps you predict where the market's going to move next. So let's look at the basic 5-3 wave sequence, which forms the basis of the Elliott Wave Theory. So here to the right, we can see a 5-wave sequence. Waves 1, 3, and 5 are called impulse waves because they move with the dominant trend. So here we see waves 1, 3, and 5 moving upwards. In the case of a downtrend, it would just be the inverse. Waves 2 and 4 are corrective waves because they move counter to the trend. So this is the first part of the 5-3 wave sequence. We can see this has 5 parts. The 5-wave sequence represents a basic impulse advance. Now, impulse advance means a move in the direction of the broader trend. Now, what's expected to follow the impulse advance in the 5-3 sequence is a corrective phase. So following the impulse advance, the basic 5-3 pattern has a corrective phase formed by 3 waves, which are typically marked A, B, and C. The 5-wave impulse phase followed by a 3-wave corrective phase marks the complete Elliott wave sequence with a total of 8 waves. So we have the impulse phase here, 1, 2, 3, 4, 5, these 5 waves, and the corrective phase here marked by A, B, and C. This has got 5 parts and this has got 3 parts, so this is what makes up the basic 5-3 wave sequence. And this is what lies at the core of Elliott Wave Theory. So Elliott waves are fractal, and let's talk about the fractal nature of Elliott waves. First of all, fractals are structures that can be split into parts, each of which is a very similar copy of the whole. This is something that we see a lot in nature, for example, in snowflakes, seashells, broccoli is another one, Romanesco broccoli is another example. So Elliott waves are also fractal. Each wave can be split into parts, each of which is a very similar copy of the whole. So we're going to see this illustrated in the next slide. So here we can see within this upward wave here, the entire phase is contained within this leg. So any impulse wave subdivides into 5 smaller waves. Any corrective wave subdivides into 3 smaller waves. No matter how big or small the wave degree, impulse waves take on a 5-wave sequence and corrective waves take on a 3-wave sequence. So in this kind of illustrates how the Elliott wave theory can be applied across multiple time frames, whether you're looking at decades or all the way down to minutes. So Elliott assigned a series of categories to the waves in order of the largest to the smallest time frames. So he applied it to multi-century grand supercycles of 40 to 70 years, a cycle of 1 to several years, primary a few months to a couple of years, intermediate from weeks to months, minor composed of weeks, minute composed of days, minuet composed of hours, and sub-minuet composed of minutes. So the idea is that this 5-3 pattern plays out across all of these different time frames, whether it's a grand supercycle all the way down to a sub-minuet made of minutes. You're going to see this 5-3 pattern playing out over and over and over again. So Elliott laid out some unbreakable rules for when you're trying to identify a pattern. So rule number 1, wave 3 can never be the shortest among the 3 impulse waves. Rule number 2, wave 2 can never retrace beyond the low of wave 1. And rule number 3, wave 4 can never retrace into the price area covered by wave 1. So these are unbreakable rules, and when you're getting into Elliott wave analysis, it can often be a process of kind of deduction, just just making sure that none of these rules are broken in order to be able to identify the pattern as a genuine cycle. Next up, let's talk about Fibonacci and Elliott Wave Theory. Fibonacci ratios can be used in forecasting an individual wave's move within an Elliott wave pattern. So this is something that potentially has predictive value and something that you could apply in your trading fairly quickly. So, for example, wave 2 often retraces to 50% or 61% or 76.4% or 85.4. These are all Fibonacci ratios of wave 1. So here we have wave 1, and here we have the retracement of wave 1. So you might be looking for price to retrace to one of these levels. That's the scenario that often plays out. Wave 3 often extends to 161.8 of wave 1. Wave 4, we're talking about retracements again to these Fibonacci ratios of the wave 3. You'll often see a retracement to 23% or 38% and so forth. Wave C, in the corrective move here, often extends 61.8% lower than wave A. So let's talk about where these Fibonacci ratios are derived from quickly. In the Fibonacci sequence of numbers, after 1 and 0, each number is the sum of the two prior numbers. So here we have the Fibonacci sequence of numbers. So we know what the Fibonacci numbers are, but where do these ratios come from? So the basis of these ratios comes from dividing a number in the series by the number, another number in the series. So the golden Fibonacci ratio of 61.8 comes from dividing any number in the Fibonacci series by the number that follows it. So for example, 89 divided by 144 is 0.618. And then these other ratios are also derived from the relationships between the numbers in the Fibonacci sequence of numbers. So the 38.2 ratio is derived from dividing a number in the Fibonacci series, number series, by the number 2 places to the right, and so forth. So that's where you get these Fibonacci ratios from. So in conclusion, the key in using Elliott wave theory in trading is being able to correctly identify the waves. So you're going to want to look at those 3 cardinal unbreakable rules and make sure the potential sequence that you're looking at is in line with all those rules. There's also a number of guidelines that you can observe. So using the rules and guidelines will allow you to begin to correctly identify the sequences. And once you identify the sequences, you're going to be able to forecast potentially where price is going to go. And being able to identify these sequences, in other words, has predictive value. Once you begin to recognize patterns, you can use these to aid you in developing your trading strategy and your trading decisions. So with that, guys, we're going to wrap it up today. I want to thank you very much for joining us. If you have any questions, please do email them to us, webinar@OctaFX. And I look forward to seeing you in the next educational webinar. Thanks for joining us and good trading.